Common question is, what is a real estate investment trust, or a REIT? And how does it differ exactly from a real estate fund or a real estate syndication? Let's talk about those differences. Let's start talking about REITs, real estate investment trusts. So what exactly are they and how do they work? Well, a real estate investment trust is a fund of sorts. It is a kind of real estate fund. What it is it accumulates real estate and it pays out based on the income of that real estate. So all REITs are required to pay out 90% of their income that's derived from rents as dividends to their investors. Now, a REIT really it's a subclassification of the tax code. It's not a different kind of security as far as the SEC is concerned. What that means is there are REITs that are structured as Regulation D offerings. There are REITs that are structured as Regulation A offerings, and there are REITs that are public, that have they've gone public, and they do that. They meet the minimum requirements, which primarily is a certain amount of ownership needs to be in people other than those managing, and that they pay out 90% of their income, and that 75% or more of their holdings is in real estate specifically, not necessarily not bonds or anything like that, but in the real estate itself, and that they also have more than 100 investors that are not part of the management team itself. That's the basic structure of a REIT. The benefits of a REIT are that they are very liquid, especially a public REIT. Public REIT, you can trade on the stock market. You can log into your brokerage account and make a trade and then sell it the very next hour. So they're very, very liquid. Whereas with a real estate fund, a private fund, it may be less liquid. Now, private REITs are also going to be less liquid, but they're going to have specific mechanisms in place in order to get people, make it easier to liquefy their positions, so they can sell it at regular intervals. When a REIT is put together, what is oftentimes needs to happen is that figuring out the greatest challenge of net asset value. Now, net asset value only comes into play as it relates to private REITs. So private REITs have to figure out net asset value on a regular basis. Most of the ones that I know and have talked to and follow and have consulted with, those REITs that are private, they do it on a monthly basis. Now, monthly is a lot of time. It's a lot of work in order to adjust your net asset value. But that's their regular schedule. Public REITs, however, doesn't matter. The net asset value is computed by itself, just naturally, by being on the public market. It's how the public perceives the net asset value and how it changes stock price. So there you might get valuations of, $30 based on income or something like that. But basically, the bottom line is that net asset value, very critical for private REITs, and for public REITs, not a factor at all, necessarily. Not a factor as it relates, at least as it relates to share price, because the share price is determined by the market itself. So let's go through the main takeaways and key points of REITs and real estate funds. Number one, REITs are companies that buy and manage property and generate income from rents primarily. They're not in the business of selling properties for their own sake or counting on appreciation. They distribute 90% of their profits as dividends to shareholders, and their main benefit is this massive amount of liquidity. Number two, real estate funds and syndications, they gather funds from multiple investors for buying, managing, developing, selling properties. Generally, they have less liquidity, larger minimum investment, but they offer a much wider range of options of things that you can do. This is where the majority of our clients are. We have a very small number of REITs that we help, and then we generally help your all the way from your very, very large private equity funds all the way down to first-time syndicators. Number 3, investment in real estate funds. It offers those benefits of diversification and true professional management, but it's subject to that market volatility. Generally, these are smaller, so they have a little bit less holdings than a REIT, which can oftentimes be quite large. As property values decline, high fees, lock-in periods. They also track slightly different than REITs on value. Number 4, REITs and real estate funds have different tax implications. REITs dividends are subject to income tax, whereas real estate funds and syndications in general are much more likely to target being taxed at the capital gains rate. Number 5, as a syndicator or a real estate fund manager yourself, your job is to really consider what's in it for your investors and what are you putting this together for. What is your founder's investment theory? Use that in determining whether going down the road and the expense and complication of putting together a huge business like a REIT makes sense. A lot of my players, very, very, very large investors who have assets under management of well over $1 billion are not REITs and will never be REITs and do not want to play that game. They don't even put together funds. They put together just straight syndications. So your success is not tied to, well, whether you are a publicly traded REIT or not. Your success is tied with doing the kinds of deals and the kinds of funds that you want to do and working with the investors that you want to work with. My name is Tilden Moschetti. I am a real estate syndication attorney with the Moschetti Syndication Law Group. I hope this video helped explain that difference between REITs and private equity funds and syndications. If we can help you on your journey, whether it's to become a REIT or a private equity fund or a syndicator yourself, give us a call. We can help you stay compliant with Regulation D Rules 506B and 506C, and also offer you the expert guidance to make sure that you get on the path that you're going and get to the goal that you want to get to.